So last year, markets did nothing. So does anyone, who was here beginning of forecast 2015? Do you remember what it is we talked about? So specifically, we talked about in 3 or 4 of those different sessions, up until actually late June, July of this year, we talked about the fact that the market was ahead of the economy, which should be no surprise to anybody. Like we had a grinding, slow growth economy, and we still have that grinding, slow growth economy. But the market got ahead of it, right? And earnings estimates were high and they came down, and they were high again and they came down. And so 5 years in a row, they expected earnings to be higher and they came in lower. But still, the market was leading. So what has to happen? We have to have a year where the market does nothing or goes negative. We have to get back to an average PE ratio, right? So this should be a matter of course. Now, I didn't know how it was going to happen. I didn't know it was going to be just a flat market. I didn't know it was going to be, and I don't know January is going to happen. That's not what it's not about predicting. It's about there's a natural cycle like sunrise and sunset. And this is the natural cycle. PE is price earnings ratio. And it's the simplest measure of value. So it's the price you pay for every unit dollar of earnings that a company or a country or an index might have. And the higher price you pay, the less value you're getting because it's still $1, right?
Right.
So if you pay a higher price, not as good a deal as if you pay a lower price for that same dollar, right? Okay. So MSCI World is kind of what we use as our benchmark, and then we blend that with fixed income if you have a less aggressive portfolio. And last year, the MSCI was down 2.74, right? Now, the interesting thing about the call that we made in the last couple of years was we liked Europe better, and we were absolutely right, but we were still wrong. Why were we wrong? We're not talking about this today, but I wanted to just mention this. Currency. Europe did far better than the US last year. But when you translate that into those earnings into US dollars, we lost 8% on currency, we made 6%, we lost 2%, right? So didn't matter that the euro did better.
Great time to travel in Europe.
Great time to travel in Europe, or pretty much anywhere in the world right now. I mean, the dollar's strong. Okay. So again, perspective. This is our experience, but this is the same experience. What's the difference here? Scale, right?
Yeah.
We're looking at this between, I think, just under 19, just over, what was it, 21? 21, right? And this one we're looking from the beginning to now. So you're looking at the long term, there's not that much movement. And when you think about this in a 20-year, 30-year retirement, 50 years leading up to retirement and in retirement, 100 years, well, we're not thinking about 100 years, but if you think about legacy, my dad's here, so I'm hoping there's a legacy to come someday. That fell flat. Wow, okay. All right. So at the same time, inside that, if you look too close at it in 1 year period and it looks really volatile, but if you look distance, inside that, there's a lot of moving parts, right? These are the sectors. Now, if you were invested in these sectors, right, you underperformed. If you were invested in these sectors, you overperformed. What does that tell us? Nothing about tomorrow. This tells us what happened yesterday, right? So we can't use this and say, okay, we're going to invest this other way now. So when we buy an index, when we buy a portfolio, we buy all of it. And we're going to be a lot more broadly based than the S&P 500. And we're going to talk about that specifically in a second as well. Okay. Uncertainty. What was the biggest uncertainty part last year? The Fed. What's happening with the Fed? What's happening with the Fed? What's happening with the Fed? And so here we see, this is November 2014. This is, December, end of December. This is basically where we stopped the year 2014 and started 2015. And the whole year we see volatile, but an increase in the 10-year Treasury. So when you have an increase in a 10-year Treasury yield, what does that do to the price of the 10-year Treasury? Price and yield are inverse, right? So if you had a 10-year Treasury, the yield goes up, price goes down, okay? If you had a 30-year Treasury, you lost a bunch of money last year. And you probably will lose a whole bunch more money in the next few years. The last transaction we made, if you have portfolios with us, is December 31st. We sold the remainder of our portfolio fixed income that has any sense of duration. We got rid of all the duration because from now for the next foreseeable future, rates are going up. They may steady for a little while and then go up a little bit. This is the one thing that we may see that would scare me, And that's if we go up, and the Fed decides, no, we have to go back down. And that's happened in multiple economies.